Good morning. This is IG's early morning call on Thursday, 13th of April. Let's take a look at the headlines as we see the aftermath from that weaker than expected CPI data out yesterday in the States is pushing the dollar down to 2-month lows. Fed minutes last night also really giving some sort of idea that the dollar is likely to weaken rather than strengthen. And oil prices setting new highs for this year, supported by demand coming through from China. And we've just seen Tesco break across the news wires. We've got full year earnings pretty much in line with the strong expectations. Let's take a look at volatility. We're down today, down at 20.74. This trend that we've got in place, the speed of the deceleration is beginning to abate. And in fact, we've got what now appears to me to be this rising line of support, which looks like it could well now be held. Whilst we're down today, we were up yesterday, so we're now beginning to flatten out. And you can see this reflected in the MACD here as we see this begin to start to flatten out on the downside. Are we in for a period of upside? Well, at the moment, there's no evidence of it. And in fact, if we look at what's been happening here, this is the London market. I've drawn this vertical line here, the vertical dotted line, which is the close yesterday on these 30-minute candles. We are technically speaking down, but I'm now wondering whether perhaps maybe we might actually see a slightly stronger start to the European markets. Tweeted about this earlier on this morning. If you don't catch my early morning tweets, sign up because I give an indication of the sort of things we'll be looking at in the early morning call. And some of the points I was mentioning is the fact we could well see possible upside because of some of the earnings out this morning. Tesco, I think, could well deliver a little bit of a positive kick to the start of today's trade. And indeed, as you can see here, since 7 o'clock, we've got this strong candle here and another one building at the moment on these 30-minute candles. So at the moment, at least, we're looking as though we could well see a small drop at the start, but I think that could well turn around in the next half hour or so. Let's look at the daily candle, pardon me, just to show you what happened yesterday, because we ended well off the lows. Because we saw a slide late in the session yesterday on Wall Street, and this pulled back the markets in the London session, not just London, but across the rest of Europe as well. Same sort of price action that we saw, a really big upper wick, and in fact a red candle body yesterday on the German markets. But in today's session, we've seen a little bit of a rebound. Again, same sort of thing. We're not quite as high as we were as at the close of the cash session yesterday. But interesting enough, yesterday, intraday, we've seen the highest print on the German DAX that we've seen since the 20th of January 2022, so 14-month highs plus for the German DAX, as at the intraday high yesterday. And we're now up a whopping 34% from the lows we had back in October. The recovery in the French markets continues. In fact, it's not now a recovery. It has a new intraday all-time record high yesterday on the CAC 40. With that spike high yesterday, and indeed we're building on that today. French markets absolutely on a rip today, and indeed the recent performance we've seen, as we'll demonstrate in just a couple of minutes' time. One of the runaway stocks likely on the upside this morning is going to be LVMH. We saw some really robust figures coming out late yesterday across the wires last night after the French market closed. So these 24-hour markets, I think, beginning to price in a very strong start to LVMH this morning. So let's take a look at what's happening overnight in the Asia-Pacific markets. Alibaba down 5% plus in Hong Kong after SoftBank stake sale, reports for stake sale by SoftBank in Alibaba. Hang Seng Stock Index down 0.75%. Also pressure on the downside for the ASX 200. Small gains on the Nikkei of a rise of 0.1%. Want to take a look at Wall Street. Late yesterday, as I said, we got what was essentially markets on the way down. Ultimately, we saw a positive sort of mid-session swing. We got that slightly weaker than expected headline inflation number out yesterday, indicating the Fed may be encouraged to take its foot off the accelerator in terms of monetary policy tightening. And this was backed up by the Fed minutes. We'll take a look at that in just a few moments' time. I want to show you what's been happening with the NASDAQ. That drop we saw yesterday was by far the biggest drop on Wall Street yesterday, and that's that candle there taking us down intraday to levels not seen since the 29th of March, 12,876. A little bit of buying interest at the lows today, but that's the swing of things there. On the NASDAQ, the better performing market has been the Dow. Yesterday, up at levels not seen there since the 16th of February intraday before a pullback late in the session yesterday. A little bit of buying interest at the lows today, but broadly speaking, this is an uptrend which hasn't really, doesn't look like it's going to reverse anytime soon. That being said, like I was talking about the bottoming out of the VIX, look at the way in which this momentum is beginning to start to peak, I think, possibly making an opportunity to sell. But I wouldn't want to take this market down too far, because the bottom line is there's nowhere else really for the markets at the moment, at least, to hide. Certainly not so far as the dollar is concerned. It remains on the back foot this morning. The greenback falling yesterday afternoon after the release of the cooler than expected CPI data. Let's take a look at the numbers that we saw yesterday. US consumer prices rising 0.1% in March, month-to-month last month, after rising 0.4% in February. Now, the market expected a gain of 0.2%. The year-on-year figure, the index up by 5%. Now, this is its slowest rate of headline growth in inflation in CPI since May 2021. And as we've been witnessing, the dollar certainly got no support from that number. And indeed, if you look at the dollar basket that we saw yesterday, this is the dollar basket, second day in a row of losses yesterday, a little bit of buying interest this morning. That big downside was helped along by the Fed minutes. That showed that several Federal Reserve policymakers considered pausing interest rate increases after the failure of Silicon Valley Bank and Signature Bank. But the conclusion was that tackling high inflation remained the priority. Now, one might expect a little bit more buying of the US dollar, but interesting enough, it really hasn't stirred. And in fact, yesterday we saw the euro trading at highs not seen since the 2nd of February. And in fact, if we pull this line up there, you can see that's going to be the next line of resistance at 110.33. We're currently trading at 109.85. A little bit of a sell down today, but only by a small margin in what is otherwise, I think, a fairly strong trend on the upside. If we get a break of the 110.33, you're then at levels there not seen since March 2022. Now, interesting enough, we've almost got a conclusion of, or rather, this inverted head and shoulders here for sterling against the US dollar. We're very close to seeing us break through the neckline. Not quite at the moment, but this little bit of an uptick here is taking us up to the 125.26 level. Let me just take that line off to get some little bit more clarity here. And there we are. So now we've got this inverted head and shoulders almost completing. When it passes this neckline here on the upside, the inversion then starts to take effect. And technically, what you do is you measure the inverted head to the neckline, then project it with the break. We haven't yet got the break, but if we were to get a conclusion of this technical pattern, you'd then be seeing sterling up at levels not seen since June 2016. Is that possible? It's going to take some time if it does happen, but this would certainly mean substantial dollar weakness, I think, coming through in the next few months if we are to see anything like this sort of performance. But once we get a break in the neckline, we'll keep a monitor on this and work out when that happens, and we'll see how things develop for sterling in this pattern. So the minutes yesterday from the Fed showing staff projections of a mild recession later this year in the States, followed by a recovery in 2024, 2025. And at the moment, at least, that's showing some dollar weakness. Let's catch up with what's happening in other areas of the world. China. I want to tune in to what's been happening overnight. I was talking about this in the look ahead yesterday. Exports unexpectedly rose in March, rising 14.8%, very strong number, ending 5 months of declines. Economists polled by Reuters had expected exports to fall by 7%. Imports rose by a smaller than expected 1.4%, meaning that the trade surplus was much stronger than anticipated at just over $88 billion. Now, China's crude oil imports rose 22% in March from this time last year, and that has given a kick up to the price of oil. I want to show you what's been going on with oil because this does relate very strongly to what we've been seeing in the Chinese economy for all this data. This is US crude. Now, US crude is stronger than the numbers out on Brent. Yesterday, we saw a break of this line at 82.65 and a candle close beyond that, taking us to intraday to levels not seen since December last year. And in fact, the strong downdraft last year, down the 17th of November, which is pretty much where we are. And significantly today, look, it's only a very, very slim candle, but let me tell you, it is above. Yesterday, we got a close above the 200-day moving average, so an entire candle today above that, which for those that follow simple moving averages is a key place to watch. And when you get a break above that, it normally gives you a further indication or a further support of anybody that's long in this market. Now, you'll see there's this big gap that opened up here between 31st of March and the 3rd of April, over that weekend, when we saw the announcement by OPEC that it would take a further 1 million barrels plus a day off the market, on from the 2 million we already know that was in the market. And this has seen this price rise. Yesterday, we saw the Chinese data coming through, showing us that crude imports averaged 12.3 million barrels a day in China, which is an increase in the March number, 22% from this time last year. So that shows that there's more demand coming through as expected in China. Now, the US crude oil inventories unexpectedly rose last week, according to EIA data, helped by the release of the US Strategic Petroleum Reserves. Crude stocks up by 597,000 barrels. Analysts had forecast a 600,000 barrel drop. Stocks of crude oil in the Strategic Petroleum Reserve declined 1.6 million barrels, the first drawdown this year. Gasoline and distillate inventories fell far less than expected, 300,000 and 600,000 barrels, respectively. I just want to quickly show you what's happening with Brent. Brent is not as strong as the numbers that we've seen for US crude. That push higher took us to levels they're not seen since January this year. So we're not quite at highs for this year as far as Brent is concerned, which has been the move up that we've seen in WTI. Let's turn on to Australia. We've got jobs data out overnight, jumping early this morning already, so another strong jobs report in the country. Unemployment rate holding near 50-year lows at the 3.5% level in March, while the employment numbers themselves blew past expectations for a second month. Net employment rising 53,000 in March from February. Markets had forecast a rise of just 20,000. Full-time employment surging by 72,200 after a similar increase in February. Full-time employment is particularly important in Australia as it gives visibility to households and gives them confidence to increase spending, not just in Australia, of course. That is the sort of figures you expect anywhere in any economy. It's always good to see some full-time employment rise. I want to show you what's happening with the Aussie dollar. This is one of the better performers in the markets. Third day in a row of gains for the Aussie against the US dollar at 67.13. If you're long on this, stock goes down here at around about the 66 level. 67.13 is where we are. What's it mean for interest rates? Well, strong job gains could mean a slower return on the inflation target. It suggests that the RBA tightening campaign may not yet be over. Let's take a look at what's happening in the UK. We got some GDP out this morning. Monthly GDP for February flat. Market had expected a 0.1% expansion. Industrial production fell by 3.1% year on year, less than the 3.7% drop economists anticipated. You remember yesterday we were talking about the picture for the outlook for growth in the UK. Jeremy Hunt, I noticed yesterday, coming out with a statement suggesting the IMF is generally very, very bearish on the UK economy, and that's failed to bear out. Remember, the IMF was predicting a recession at the back end of last year, and quarters 3 and 4 it didn't actually come to pass. But nonetheless, this monthly GDP number is showing weakness in the month of February. 3-month average, 0.1%, the consensus flat. So you really take your choice in which number to follow. But certainly when we start to see the first quarter numbers start to develop in some more detail, we'll get a better picture of just how, and indeed whether or not the UK economy is going to go into recession this year, which I think is the baseline for the IMF. But it will be a shallower recession, I think, than some IMF members had initially been expecting. Just want to quickly return to this sterling chart again, just to remind you that we will be following this inverted head and shoulders, depending on the continuation of the data coming through here in the UK. Staying on the sterling chart, just wanted to quickly look at what's happening in GBP versus the euro area, which is the other big cross to watch out for. We're up today. It's really flatlining recently at around about the 113.60 level. 10 o'clock this morning, we had industrial production in the Eurozone expected to rise by 1% in February compared to January. And in the States, later on, the market awaiting producer prices for the month of March and the weekly initial jobless claims looking there for a figure of 232,000 for last week's numbers for the weekly jobless figures. Let's move on to take a look at some of the corporates out this morning. I want to begin first of all with the UK's largest supermarket company, Tesco, on full year numbers out this morning. Interesting read, actually. Although There's nothing that's really biting me in terms of something to give me impetus to give a big move in the share price. But I can't see any reason to sell this Tesco level. I'll show you the share price chart in just a minute. But the operating profit, 2.63 billion, in line with expectations. The company expects what it says a flat profit in the 2023-2024 period. Adjusted operating profit at 2.6 billion was absolutely in line with what Bloomberg had been expecting. The proposed final dividend has come through in line with last year's full year dividend of 10.9 pence per share. Fourth quarter like-for-like sales increased 7.6%. That included that Christmas period. So, as I said, there's nothing negative in these numbers, I don't think. The only question I would have is just how much strength that we've seen in the share price has been in advance of these numbers. In other words, could this be an opportunity to sell at 266 pence? I don't think there's any reason necessarily to sell this stock down. It has been doing brisk business on the upside recently. So far as upside is concerned, if we do get a positive surprise to the share price this morning as a result of confirmation of the numbers today, 266 pence, I put my stop down here at around about the 260 pence level, with a view then to meeting or possibly breaking the 271.9. As I said, I can't necessarily see any reason as to why we should sell big time this stock, but we'll have to see how things open at the beginning of trade at the top of the hour. Let me stay on the charts and just quickly bring up another one I think worth looking at this morning. Imperial Brands. It's only a trading statement this morning. The stock ended down at 1881. The company says it's on track to meet full year guidance. First half adjusted operating profit will be similar to the first half of 2022. The stock recently has hit levels they're not seen since September last year. So we're flatlining at the moment at around about the £18.80 level. That stock opening in the wake of the first quarter trading statement we've seen today. One of the big stocks expected on the upside this morning is the French luxury goods maker LVMH. It's seen what it says was a significant rebound in sales in Asia, which has helped boost its first quarter numbers. The easing of the COVID-19 lockdown restrictions, of course, you'll remember, particularly in China, has been a big generator of that climb in sales, according to the company. Sales up 17% globally. Fashion and leather organic sales up 18%. Estimates have been for a 9.8% rise, according to Bloomberg. So that's far better than had been expected. This French luxury goods company, which owns brands including Moët, Hennessy, Louis Vuitton, is almost 50% owned by the world's richest man, Bernard Arnault. He held an excellent start to the year, despite ongoing global economic uncertainty amid the Ukraine war and concerns over inflation. Just an interesting side note for Bernard Arnault. We were talking earlier about this before we went to air this morning. 1980s, he took something like around about $15 million, I think it was at the time, of family money to buy into Christian Dior and the company. And the family has never looked back. Now he's the world's richest man, and the family benefiting from his investments. And you've only got to look at the share price to see what's happening. Let me just quickly run this back as far as I can. There we have the move that we've seen. That takes you back to 1990, when the stock was at the lows of around about 20, which would have been French francs, I guess, at that point, or the equivalent of euros. However, that's built into the share price chart. But you've only got to look at the direction of travel to realize how good this investment has been for so many people. We're off the recent highs. The record high was 855.20. Which was the intraday high we saw back on the 5th of April. We will open at 836.20. This is a wonderful story. This all came out late last night after the close of the French market. So I think we're expecting a little bit of a positive start to the beginning of trade for LVMH today. Now, let's take a look at one other stock story I think worth mentioning. Overnight, we've seen some interesting data coming through from Apple, moving fast to increase its iPhone output in India. Remember, we covered this a short while ago, talking about the fact that Apple wanted to move away from its dependence in China, and it's doing so really well. Bloomberg was reporting this morning that Apple assembled more than $7 billion worth of iPhones in India last fiscal year, tripling production in the world's fastest growing smartphone arena after accelerating a move beyond China. The US company now makes almost 7% of its iPhones in India through expanding partners from Foxconn Technology to Pegatron, another company that's big in production in India. Now, that's a significant leap for India, which accounted for an estimated 1% of the world's iPhones in 2021. 7% now. You can see the increase in business it's had. Also this morning, a Japanese newspaper, Nikkei, reporting that Apple is in talks with suppliers to make MacBooks in Thailand. The group is already mass producing its Apple Watch in Thailand for more than a year. Apple is one of these all-session stocks on the IG platform. Had a little bit of a rally a little bit of a easing back into the rally that we've seen recently. That rally from the lows that we had, back on the 3rd of January, 34% rise in the stock. A little bit of a move down recently, down to $159.85. Just want to show you pretty much not too far away from the middle of the distance between the 2 million and the 3 trillion market cap for the company. That 3 trillion was back in January 2022. The company continues to dominate the iPhone market, of course. Let me just round off with a couple more areas of the market I think worth looking at. Just want to take a look at what's going on with gold. With that weaker than expected CPI number yesterday, we saw a nice spike up in gold. Not quite as high as we were back on the 5th of April, but this rise that we've seen has taken us up almost 13% from the lows that we had in gold back in February this year. Currently trading at 2020. The market not too far away from the record highs at 2070. That's it. Not really got much else to say, I don't think. Do watch out for Tesco at the start of the day's trade. It's certainly going to be one of the stocks to watch at the beginning of the session in the London markets. French markets definitely getting a boost from LVMH last night. Absolutely blockbuster number yesterday, with the company benefiting, especially from China, but benefiting from global demand of its products. LVMH out late after the bell last night could well be a mover on the upside on the French markets at the top of the hour. We're back at 10:30 with Charting the Markets. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.